PMS has been gaining traction among HNIs, especially with discretionary portfolios touching 23.7 trillion rupees. But from a tax standpoint, how do PMS and mutual funds compare? Let's take a look.
That's a good question, Nakul. Let's break it down. I'll take mutual funds and you explain the PMS side.
So let's go by category. In PMS, the investor directly owns the stock in their demat account. So whenever the PMS manager initiates a sell in a stock, even if the investor hasn't withdrawn money, it triggers a taxable event. For example, if a stock bought for 5 lakh is sold for 7.5 lakh within 11 months, the 2.5 lakh gain is considered short-term capital gain and that's taxed at 20%.
With mutual funds, the same scenario plays out differently. Let's say the mutual fund manager also buys a stock that grows from 5 lakh to 7.5 lakh in 11 months and decides to sell it. That internal transaction doesn't create any tax event for the investor. So the investor is only taxed when they redeem their mutual fund units. So even if there is a frequent buying and selling within the fund, no capital gains tax is due until the investor exits. That deferral of tax makes mutual funds more efficient, especially for long-term compounding.
PMS charges are usually invoiced separately. So when an investment grows from, let's say, 50 lakh to 55 lakh, the capital gain is 5 lakh. Even if you paid, say, 1 lakh in management fee, that 1 lakh isn't deducted when computing tax.
So with mutual funds, the total expense ratio or the TER is already adjusted in the NAV. If the fund charges 2%, that's baked into your returns. So if your 50 lakh corpus becomes 53.9 lakhs, your tax is on 3.9 lakhs and not 5 lakhs. So that's again more tax efficient.
Also, in PMS, dividends are credited directly to the investor's account. If the amount exceeds rupees 5,000, a 10% TDS is applied and the dividend is added to your income taxed at your slab rate.
In mutual funds, if you choose the growth option, the dividends from the underlying stocks are reinvested and reflected in the NAV. No TDS. So you only pay capital gains tax when you sell the units. Again, this is more tax efficient.
Brokerage in PMS can be added to the cost of acquisition. Say a manager buys a stock for 1 lakh and pays a 0.2% brokerage, rupees 200. That 200 is added to the cost, reducing taxable gain when the stock is eventually sold.
In mutual funds, the brokerage and other costs are absorbed within the TER. So the NAV is declared after accounting for such expenses. So investors don't have to separately track or claim them. So it's clean and automatic.
PMS offers more flexibility, transparency, and customization for the nuanced investor. But the tax structure is more active. Every transaction can have a tax consequence.
Mutual funds, on the other hand, provide a deferred and net of fees tax structure, making them more efficient for long-term wealth creation.
If you are an HNI, combining both PMS and mutual funds can help create a balanced and customized portfolio with tax efficiency. Opt for PMS strategies with lower portfolio churn to reduce the tax burden. If you're seeking tailored PMS solutions with thoughtful, low churn strategies, just fill out the form in the description. We'd be happy to help you out choose the right fit.
And if you're still in the wealth building phase, mutual funds offer a simple, efficient, and tax smart way to grow your portfolio. So even if you're planning to transition to a PMS eventually, we can help you structure your investments wisely from today. Fill out the form in the description below and our team will connect with you to guide you through the next steps.